Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in the last video we talked about the S&P 500 and the fact that we're going to look at the S&P 500 sectors and pick 5 best companies in each sector and share it with you guys. The reason I said that is because the reason I want to do this is because a lot of you have joined the community and have asked me what should I do, where should I start from. And like I said to you, in the last couple of that video, there is the ETFs, so halal ETFs. Start with that first. Okay, there's 29 videos. Some of them are a little bit outdated, but just of course watch the last few months or last couple of years. But yeah, so start with that one first, because what that gives you is an ETF has at least 200 plus companies in one ticker basically, and you pay expense ratio, which means someone else is going to maintain it, do all the hard work for you. You just pay them a little bit of your money. These days is 0.3%, okay, of the basically your portfolio and whatever, and that's it. And then you just hold on, buy them every single month, every single week, and just hold on to them. Whereas when it comes to buying individual stocks, it's a little bit more difficult. And the reason I said that is because, for example, right now I've got this company here, Public Storage. I need this company. I need to sell it, but I can't sell it because it's 7% down at the moment. So I'm going to wait for a bit. The reason I'm selling it is because their business is slightly changed and it became non-Sharia compliant, and I don't want to hold on to it. So I got a bit of a window of about 3 months, so I'm just going to wait a little bit, and once it bounces back and break even, I'll take my money. And that sort of a maintenance and keeping up with a lot of the information these companies share with whatever every single week is quite hard. So it's easier to invest in ETFs and learn about ETFs rather than actually invest in individual stocks. But if you are interested in individual stocks, because I genuinely love to basically invest in individual stocks because I learn so much about it and I like the businesses, and it gives me an idea of how the world works, let alone everything else. So inshallah, if you're interested in that, what I would like to do today is watch the last video where we talked about the industrial sector. Today we're going to talk about the technology sector. Okay, so if you have not liked the video already, please do so. It takes a lot of time and effort to put these videos together, and inshallah hopefully will help you at some point. Okay, so let's get started with the first company, and the first company is Broadcom. Broadcom has a market cap of 652 billion market cap. It has a wide economic moat. Current price is $1,323 per share. Dividend yield 1.5, payout ratio 46%, and latest increase was 14%. The 5-year growth rate was 19%. Growth is basically dividend streak of basically 13 years, and annual payout is $21 right now. Safety 67%. We always said above 61 is fine. When it comes to revenue, it's about 11% in the last 5 years. Growth side of things, compound annual growth rate of 14%. When it comes to EPS, profit margin, we're looking at almost a 30%, return on equity to almost a 25%, and return on invested capital of 10%. They have $18 billion right now of free cash flow. Total return in the last 10 years, we're looking at about 36%. Now, this means this company can now pay off any debt, pay us some more dividends if they need to buy back their own shares, basically acquire other businesses. So that's a lot of money in the banks right now, and 36% return in the last 10 years is absolutely wonderful. Growth estimate next year is almost at 22%. Growth estimate next 5 years is about 15%. 29% premium right now. $1,000 is about roughly $1,000 where they think the price should be. Now looking at this company, year to date is about 18% up, and look at the earnings side of things. Okay, moving forward, you can see it's double digits every single year, and the same goes for the revenue estimates year over year, which is quite nice to see. And in terms of ratings, if we look at Wall Street, actually 23 basically strong buys, 8 buys, holds, and so on. And basically when you look at the upside, it's about 15% from where we are now. Now, the next one is CRM. CRM is one of the companies that I've talked about last couple of days. They do pay dividends, but there's not basically has no record yet. 264 billion market cap. And it has a wide economic moat. Current price $226 per share. Dividend yield of 0.6. So they only started now, so we're not even going to bother with that. But in terms of revenue side of it, 20% compound annual growth rate in the last 5 years. Same goes for EPS, about 17%. And when it comes to profit margin, when it loads up, 15%, and 9% when it comes to return on equity, 8% when it comes to return on invested capital, and $9.4 billion of free cash flow right now. Total return in the last 10 years is 18%. Growth estimate next year about basically 13%, 16% after that for every year. 24% discounted as of today. $285 per share is where they think the price should be, and right now it's 226. The next one's Qualcomm, but before we do look at Qualcomm, let's have a quick look in terms of ratings after the company has reported recently. You can see 24 strong buys, 12 buys, 14 holds, and 1 sell, and up 34% upside from where we are right now. And in terms of expectation moving forward, check this out, double digits every single year. After all these analysts have looked at 40 plus are looking at this company, and a lot of people think this company is dead and gone completely, but look at that, double digits in terms of revenue, almost double digits. So it's not fast growing, but as you know, as the other companies out there, but it is doing what it needs to be, what it needs to do basically. Qualcomm is the next one, 235 billion market cap, narrow economic mode. Price right now is just over $200 per share. Dividend yield 1.6, payout ratio 35%, and latest increase was 6%, 5-year growth rate of 5%, dividend streak of 20 years, 5 more years this company will become a dividend aristocrat, which is wonderful to see. Annual payout right now is $3.40, safety 80%, 12% in terms of revenue growth in the last 5 years. Same goes for 21% when it comes to EPS side of things, 23% profit margin, return on equity 38%, and return on invested capital 23%. $12.2 billion of free cash flow. Total return in the last 10 years, we're looking at about 11%. Growth estimate next year, 13%, 11% after that, 50% premium right now. 140 is what they think, where they think the price should be. And looking at the rating side of things first, okay, we got 16 strong buys, 6 buys, 12 holds, 1 sell, and 1 strong sell. And as you can see, it's about basically 4% downside from where we are right now. Earnings side of things, if we look at the estimation, double digits every single year for the next at least 2 years. And we've got about 30 something people looking at it, 7% and 20%, and then another 6% in the next 3 years or so. So with nothing huge, but again, it's a wonderful business to own. Next one is Adobe. We talked about this company a lot of times. 213 billion market cap, wide economic moat, $436 per share right now. They don't have any dividends. They, in terms of revenue side of things, absolutely wonderful. 16 double digits in the last 6 years, 5 years. Double digits in terms of last 5 years when it comes to EPS. And when it comes to, when it comes to profit margin, we're looking at 24%, return on equity 32%, and return on invested capital 36%. Now, when it comes to free cash flow, we got $6.5 billion of free cash flow. Total return in the last 10 years, 22%. Growth estimate next year, 13%. 13% after that, 22% discounted right now. $620 per share is where they think the price should be. Looking at Adobe, let's get started with the ratings first. 20 strong buys, 8 buys, 7 holds, 2 sells, and 1 strong sell. 40% of upside from where we are now, which is absolutely huge. So much discounted right now. 12%, 13% growth estimate in terms of next few years, and double digits again when it comes to revenue. Again, really wonderful business to own. I don't know why I don't own it yet. But next one we're talking about today is Accenture. This is one of the big consulting businesses out there. 189 billion market cap, wide economic moat, $280 per share, 1.7% of dividend yield, payout ratio 42%, which is quite low. Latest increase 15%, growth estimate next basically in the 5-year growth rate of 11%, 18 years of increase in that basically dividend. So 15 and 11, okay, in the last basically year and the last 5 years. 18 years of increase in that dividend. So another 7 years they will become a dividend aristocrat as well. Annual payout $5.16. Basically safety is a 92%. The 5-year growth rate in terms of the revenue side of it, 9%. Same goes for 10% for the EPS. Profit margin 11%, return on equity 27%, return on invested capital 32%, $8.7 billion of free cash flow. Total return in the last 10 years about 15%. Growth estimate next year we're looking at about 8%, then 8% after that. Fairly valued $292 per share is where they think the price should be. Now if we go and check this one out on Seeking Alpha, okay, let's go to ratings first. Okay, let's click this, and you can see 10 buys, strong buys, sorry, 5 buys, 11 holds, 1 sell, and it's about 35% upside from where we are right now. In terms of earnings expectation, 4%, 8%, 12%, 20%, and so on, and then 2%. So this is probably why it's down quite a bit. It's flat this year. Next year they're expecting at least about 7%, 8% after that. So software companies are a little bit in trouble now because of AI and everything else. As long as they can come out and say, okay, we're utilizing AI, this is what it's doing for us, and this is why it basically is not going to hurt our basically current moat, then hopefully then they will be okay. But there you go. That's the 5 companies I want to share with you guys. These are very profitable businesses, really wonderful businesses. I do own 1, 2, 3 out of the 5 in my portfolio right now. I did own at some point Adobe. I think I never owned Accenture. I don't know, if I can't remember now. But there you go. And when it comes to Sharia compliance side of things, there are absolutely no issues whatsoever. If you're interested in this type of business and so on, and you want to basically learn more about how to invest in the stock market and so on, of course, join us in the Patreon account, where you got a lot of brothers who are sharing good practices. I share all the time my buys, sales, things that I'm doing, inshallah. So yeah, of course, join us there. The portfolio is doing okay so far. I'll be traveling, inshallah, next week. So by the time you watch this video, I will be away. And inshallah, I'll keep you updated whatever I'm doing. Inshallah, have a wonderful day. Assalamu Alaikum.